Good afternoon. Welcome to the Chicago Money Show. We help you get informed, feel engaged, and have fun with finance. I'm your host, Bridget Sullivan Ramel, and I only own a family financial planning practice in Chicago. A lot of people have fun in college, but you have to figure out how to pay for it. We're going to make that fun too. Today, we're going to be talking about what you need to know about student loans and student financing. There's big news and new opportunities in this area if you have student loans or are thinking about getting them. My guest today is Patti Hughes. Patti Hughes is the principal of Lake Light Wealth Advisory Group, a family financial planning firm based in Chicago. She was named one of the best financial advisors in Chicago by MoneyUnder30.com. She specializes in helping people with pre-retirement years with retirement, tax, insurance, and estate planning. She helps a lot of young professionals with financial planning as well, talking about saving for a down payment, paying off student loans, and figuring out how to invest. Welcome, Patti.
Thank you for having me.
Oh, okay. So big news in the student loan world was a recent development about having your loans forgiven. In the past, a lot of people were struggling with this. With recent legislation, though, it's making it a lot easier. There's a one-time opportunity. Why don't you tell us about it?
So first of all, there's a couple things that have gone on with COVID that are really timely right now. The first thing is that payments on the student loans were suspended from March of 2020, and it's going to be ending January 31st of 2022. So I am just getting tons of calls from clients that are saying, what am I going to do when this restarts? So that was really big news that people didn't have to pay their payments and interest didn't accrue. The other really good thing that happened was that all of those months counted towards loan forgiveness. So that was huge. So people weren't making payments, but those months counted towards forgiveness. So that was a really big deal. And again, that ends next month. But then the latest announcement was President Biden in October announced this PSLF waiver, which is a really big deal. So the PSLF waiver basically is going to allow borrowers who previously could not obtain loan forgiveness for whatever reason. A lot of times it was that they weren't on the right income-driven repayment plan. Maybe their payments were late or it wasn't for the correct amount. Or there could be a number of reasons why they weren't eligible. So also they might have had the wrong type of loans. There were these old loans called FEL loans and Perkins loans, and they weren't eligible. So some of these people who had these old loans but had worked for a nonprofit forever just thought, well, I'm not eligible. Well, now the new thing that came up is for the next year, all of these people's, their loan payments are going to count. So in other words, if you had a FEL loan or a Perkins loan, as long as you consolidate that into a direct loan before October 31st of 2022, then those old payments will count towards loan forgiveness, which is huge. Because I have clients that have made like 8 years worth of payments, but then they get a Perkins or a FEL loan. So as long as they consolidate by October 31st, then these payments will count. And the other thing about that is normally when you consolidate your loan, the time clock restarts. So it's not a good idea. But with this waiver, they're allowing people to do that and not restarting the time clock. So it's really a big deal.
Okay, so I need to break this down a little bit more. Okay,
Mm-hmm.
So first of all, PSL is public service loans. So that is anybody who worked for a non-for-profit now that they're employed, or has worked for one since leaving college.
Yes.
Okay.
So
go ahead.
And government employees as well are covered.
Okay, great. Okay, so government, school district, a lot of hospitals. So it's a little wider than what you think of when you think of public service. Okay, so and so there's a window between now and October 2022 where the ability to have the student loans forgiven is a lot wider than it used to be and usually is. Would you say that's true?
Yes. So, what if you've ever worked for a nonprofit and if you have student loans? I think it's really worthwhile to look at this waiver to see if you qualify because, like I said, it really expands the number of borrowers that are going to qualify for this public service loan forgiveness, and it's only 10-year forgiveness as opposed to regular income-driven repayment plans are 20 to 25 years. So and it's not taxable, whereas regular loan forgiveness is taxable. So this is a big deal.
And if people, we'll get into a few more details, but if people want to
Mhm.
check this out, like again, if you've worked for as a public service and you have student loans, you can check it out at what was that website again?
Studentaid.gov.
Studentaid.gov. Okay, great.
Yeah, and they have a PSLF tool on there, which is great. You can put your information in, and then you can check if your employer qualifies. You can also check to see how many payments you have that qualify for public service loan forgiveness. So it's really a good tool.
And you can't sit back and think, oh, my loan servicer is going to contact me and help me out with this, because that's unlikely to happen. It's more like you have to be proactive and look into this and see if you're eligible and then take some more action. Is that correct?
Right. So no one's going to reach out to you to say, oh, hey, you're probably eligible and to do this. So it's really, you have to be proactive, and you have to do this on your own.
Right. Okay, great. I had gotten a question before from a viewer, and they said that they got loans when they were in college, and this was quite a while ago, and they consolidated. They were Stafford loans, and
Mhm.
they consolidated in 2003. They were subsidized and unsubsidized. And
Mhm.
so they consolidated them in 2003. Seemed like a good idea at the time, and probably was a good idea at the time. But now they work for a not-for-profit, and they have for years. And they see people who are just getting out of college with the potential of getting loan forgiveness, and they're very demoralized because they felt like they weren't eligible for loan forgiveness. So, what do you say in that situation?
So if they truly consolidated their loan back in 2003, any of these, then it became a direct federal loan, and then it was eligible for PSLF. The one thing is the PSLF program started in 2007. So only those payments from 2007 going forward would count. But from 2007 till now, that's over 10 years of payments. So
Right.
they could potentially have all of these payments count towards loan forgiveness and they could be done, which would be
Okay.
amazing.
Okay, great. So then the other question I have, you mentioned at the beginning of the show about the pause, the student loan pause because of COVID. Now, do you
Yes.
think there's any possibility that pause will be extended, or do you think no, get ready, you're gonna start paying your student loans back?
I don't think it's going to be extended again. In fact, I read something yesterday and they interviewed like 6 experts in the field and different people in the government, and everybody said the same thing. This is the end of it. So, really, what I'm telling all of my clients is that be prepared to start, and that the payments can start as early as January 31st of 2022. So that's next month. And it's really important for them to log into their account at studentaid.gov account, make sure that their payment information is correct, because payments are going to start. So to make sure that everything is up to date.
Yeah, that makes sense. Okay, now
Yeah.
let's switch gears a little bit and talk about paying for college. And so,
Hmm.
when people are going to pay for college, it seems like a lot of parents might have mixed feelings about their ability to pay for their kids' college. And sometimes it's an awkward topic to even bring up with their kids. One parent I know was saying, or the child was telling me, like the parent always said, "Don't worry about it, don't worry about it," and then when they became a senior in high school, all of a sudden they were supposed to worry about it.
Worry
and
now.
yeah, not worry.
Yeah.
And so how do you tell parents and kids too, if the parents are not forthcoming about how to talk about this, how to talk about paying for college?
So what I usually recommend is that the conversation happens before the first application is even sent out. I think it's critical when the student, say it's the end of junior year of high school and they're looking at different schools, before they even start applying. I think it's really important to have the conversation with the parent and the child and to talk about how much is the parent able or willing to fund for the college education. And many parents are under the mistaken assumption that, oh, parents pay 100% for college. And that's really so far from the truth, you know?
Right.
So, but I think a lot of times it's just a difficult conversation. But like I told them, have that conversation early. So before applications even go out. Then what I recommend is
Wait, you know what, Patty? One second. We've got a caller. Sure. So caller, if you could tell us your name and the neighborhood you're calling from.
Hi, this is Rob. I'm calling from Pilsen. Actually, I just want to tell you I'm really enjoying the show. And I have a quick question for you. As a parent, where can I look for assistance or tuition or scholarship? Do you have any recommendations where I could look to help us cover the education costs?
Great question, Patty. What do you say to that question?
So as far as scholarships and financial aid go, you really should look at the individual school. And one of the things I was just going to bring up was that there's a site, College Data, that you can go on. It's a website, and you can look at each college and you can see how much typical aid they give the students and also scholarships. But then it's really best to contact that institution to find out, because many of my clients have obtained private scholarships, and a lot of people aren't aware of it. So they might say, oh, I don't qualify for financial aid or something. But you can look at first, what do you qualify for financial aid with the school, and then also what private scholarships are available. So a lot of times there's merit aid, or it could even be work study programs, but definitely it would be checking with the individual schools.
Great. And so let's incorporate that question also when we're talking about this conversation, back to the conversation that you're having with your child when they're filling out their application. So you sit down with them and say, okay, here's what we can do. Here's what we're expecting you to do. Here's what perhaps loans will do. You'll be applying to schools, and then we'll be filling out the FAFSA form, right? And then, so it seems like you have to kind of lay the groundwork for your kids so that they understand the whole process. Because there's like, okay, apply for a bunch of places, then see what comes back. And then we make the decision later. And so I think for kids, for the high schoolers, it's like, okay, we're gonna, how do you guide people on the process?
Well, I like I say, I recommend that first they look at the schools that they're thinking about applying to and go on that College Data website and see. You can get a very good idea of what they typically give for students. So in other words, what they're giving for merit aid, what they're giving for regular aid. So more looking at the net cost. There's another website, College Board, that they actually calculate the net price. And you put your own information in. So that's actually a really good one to go to for each school. So I recommend that people do that. And then I actually recommend that they put together a spreadsheet with each college that they're looking at and say, okay, here's actually what our price is going to be, our net price after getting any aid. And then you subtract out, what the parent is willing or able to contribute. And then the final piece would be, okay, what's left for the student? And for the student, they might be able to, do some of it through work. They might also have to get student loans. And then I suggest calculating what those payments might look like.
Yeah.
So
and I know,
it's kind of like doing it in steps. And then that way you have a real clear idea of the impact of making this decision so that you're going into it with your eyes open.
Yeah, and you understand all the different elements of it. I know Bird Whitehead and ACP, or the Alliance of Comprehensive Planners, recommended one third a payment idea of one third, one third, one third. Like one third parents pay, one third kids responsible for that could be working or scholarships, one third loans. And then if everything's going great, then the parents can help pay off the loans if everything goes well. But that I also think helps make it less overwhelming, because anybody facing one third of college, or the whole of college costs, multiplying it by 4, that overwhelms anybody. But taking one third of it and saying, okay, can I do this for a year? That seems like that helps a lot.
I think so. And the other thing is, I think with parents, for their third piece of it, students can't earn enough. They can't earn that one third. It doesn't work with the math doesn't work with how expensive college is. But parents, what I see a lot is that parents look at the third of it, and they say, a lot of parents just say, I'm going to do this out of my current earnings. In other words, they try not to touch their savings or their retirement accounts or anything like that. And they try to cut back on expenses and say, okay, now I've got a kid in college and I'm going to try and pay my third out of current earnings. Or like in some cases, maybe one of the couple, works part-time. Well, then the kids go to college and then you go to work full-time.
Right.
So a lot of times that's what I see, is that the parents do step it up as far as the income part of it. They do that first, then they maybe look at savings and as a last resort loan. So, yeah. But I think the idea of the one third is actually good to break it up, because it is really daunting when you look at college costs, what they are today, and to have to pay that for 4 years, and that's one child. If you have more than one child, it's crazy, really,
really crazy. Okay, so here's another question I got before the show. I didn't make enough money to save for my child's college, but they're saying I'm supposed to pay for most of it. I'm assuming there is the college. Should I take a home equity line of credit? I want to retire, but I'm 55 and don't have that much for retirement either. What are your thoughts there?
So basically, I never really recommend that parents touch their retirement accounts for paying for college funding. And the way I look at that is that the student has their whole lifetime to work to repay these student loans. You can get on an income-driven or payment plan for the federal one. So when your income's low, you're paying less. When the income goes up, you're paying more. But if the parents tend to take it out, at retirement, they're in their mid to late 50s when all this is going on, and that's when they're least likely to be able to, to do something like this with it not impacting their retirement in a negative way. So I really don't recommend that they use home equity loans or things like that. I just don't think it's smart, because sometimes then what happens is it impacts what they're able to spend in retirement, and they can't make it up. It's too late. It's too late to, recoup those earnings, so I really don't recommend doing that.
Great. So we've worked up a case study also, and we went through, or Patti put this together, and I've got it on my website too if anyone's interested. And we went through 3 scenarios. Patti, why don't you talk about how the scenarios ended up?
So basically what I did is I tried to look at 3 different scenarios. And the first one would be that we look at somebody who's going to a 4-year college. I looked at U of I, Champaign, and the average cost right now is $31,000 a year. I looked at for accounting. I just picked accounting and what that would be. So that, if you think about that, that's a lot. I mean, that's $124,000 in total to come up with. And so I looked at different ways you could do this. So the first way would be 100% finance with student loans. And I looked at that and I said, okay, we're going to first take advantage of the federal loans, and then we're going to look at private loans and use that. So the good thing is the federal loans have a low interest rate. So that's what you want to do first. You always want to do that first. Use the federal loans. The problem is the limitation, and it's limited to $27,000, which is not much.
For the whole 4 years.
For the whole 4 years, yeah. And then the cost is like $124,000, right. So it's a big deal. And then I look at the interest rate on those loans is like 3.73%, which is real low. Well, then for the remainder of it, if you have to finance that through private loans, the private loan, I just looked it up, and the average interest rate on the private loans is 7.64%. So there's a huge difference, over what you would get for a federal loan. The other thing is with these private loans, they require a cosigner. Well, who is going to cosign the loan? It's
Right.
going to be the parent. And if the parent cosigns the loan, then they are, liable, and if the student doesn't pay it. So the first scenario was looking at it that way. If we do it 100% financing through federal loans and then private loans, and then how does the monthly payment look? So the monthly payment on that is $1,429, and that's a lot. I mean, if you think about someone getting out of college and having to pay that,
Sounds
and then
like
having
rent.
to pay rent,
That
it's
sounds
a
like
lot.
rent.
Yeah,
Yeah.
exactly.
Yeah.
So it's very high. Then the next scenario I thought is, okay, what if the parents pay a third, the student pays a third, and the remainder is financed with student loans? So if you look at that scenario, the payment drops to $441, which is very doable. I mean, it sounds like a lot, but
it's not
much
nothing.
better.
Yeah, but it's
It's
compared to
less than
yeah.
the first
Right.
option. And then the other option would be, I just looked at going to something like a Harper College for 2 years, living at home, where the student pays for that, so the student works and pays the tuition for 2 years, and then they do student loans for the remainder of the 2 years. And then in that scenario, the payment would be $711, so in the middle.
Which was
So it
interesting.
does give you 3 options.
Yeah, and what was interesting to me on that, honestly, is that because a lot of times you think, I don't have any money, and the default is, okay, community college, and community college can be great. So I don't want to diss that. But one third, one third, one third, it shows the power of the one third, one third, one third as like, okay, if you can all contribute some, it can work out even better. Or like as far as I'm, okay. So I want to really get into the 4 big mistakes to avoid. Okay. So mistake number 1, not understanding consolidate.
So that's a big one. A lot of people will say, oh, I'm going to consolidate my loans, and they think it's a good idea. And I don't know, for some reason, I think they're thinking of like a debt consolidation loan, which is different. But what they don't realize is when they consolidate the loan, the actual interest rate is actually higher than the weighted average interest rate on the current loan. So what they do is they look at the current weighted average interest rate, and then they bump it up by 1/8 of 1%. So, so then you're paying slightly higher interest. The other thing is when you consolidate these loans, if you're on an income-driven repayment plan, then what happens is the clock restarts. So all of the progress you made towards forgiveness is gone. And so a lot of people don't realize that. Right. And I've had clients come to me and say, oh, in 2 years, all my loans are forgiven. I'm like, well, no, because you consolidated and then it restarted.
Okay.
And the third problem with consolidation is that it lengthens the amount of time that you pay the loan, because if you consolidate the loans and then it's, you start repaying, then, if you're going for 20-year forgiveness, well, then it's 20 more years that gets added on. So yeah, consolidating is sometimes not a really good idea.
Okay. Mistake 2 to avoid, not understanding private student loans.
Yeah, so a lot of people, just say, well, okay, what I don't take out in federal loans, I'm going to do private student loans. One of the things a lot of people don't realize is, first, the interest rates are a lot higher. And secondly, that there's protection with the federal loans. The federal loans are eligible for loan forgiveness. And then the other thing is, in the event of death or disability, they're forgiven for a federal loan. And in most cases with private loans, they're not discharged. So they literally follow you to the grave, which is not good.
Okay. That was another question I got, was what happens with student loans with bankruptcy? Can you just get rid of it by ignoring it, or is this thing on your back forever?
Yeah, so with bankruptcy, what happens is if you file Chapter 7 or 13 bankruptcy, a lot of people think, oh, well, I'm going to do that and my student loans are gone. Well, that's not the case. You actually have to go to court, and there's like an adversary that you have to do, and your creditors can show up. And what they will try to do is they'll have to prove that by making the student loan payments, you can't even have a minimal standard of living. So that's tough to prove. It's difficult. And then even if you prove that, then they may say no. They can discharge part of it, or they can just discharge all of it. But it's really unlikely that that happens. And it is, you've got to go to court to try to get this. It's not just filing bankruptcy and it's done. It's a bigger deal than that.
Okay, great. And now back to the mistakes to avoid. Parent plus loans. It sounded to me, when you described it to me, it sounds like loans plus a lot of fees. That's what the plus stands for. Go ahead. Tell me more about Parent Plus loans.
So the issue with the Parent Plus loans is I've had a couple clients come to me that have these, and then they're in their late 50s, and then that's when they have to start repaying them, which is when they can least afford to do it because they're looking forward to retirement. But the thing I think a lot of people don't realize is with these Parent Plus loans, they charge an origination fee of 4.228%. So that's a lot.
That's a lot.
And people don't realize it, with these Parent Plus loans. The other thing is the Parent Plus loans have the highest interest rate out of all of the federal loans. So the Parent Plus loans right now are at 6.28%.
So plus 4% origination.
Plus you have to, then they have that origination fee. So, and then the other thing about that is that then, they're not eligible for any income-driven repayment plan unless you consolidate them into a federal loan. And even then, it's the worst payment plan that you can be on. It's like this old one called ICR, which takes 20% of your discretionary income. So I'm not a big fan of the Parent Plus loans, needless to say.
And the fourth mistake to avoid is not collaborating with your kids.
Yeah, and I think that's a big one. I think a lot of these things could be avoided just having the conversation early on, like I say, before the kids even send out applications. If they can talk to the parents and figure out, okay, how much am I going to be responsible for? And also, what does that payment look like? What does that student loan payment look like? Like, am I going to be able to earn enough in whatever major I'm taking? Am I going to earn enough that I can make these payments? Because I think otherwise, it just becomes a big problem. You're just kicking the can down the road. So.
Awesome. So what are your parting, we've got 2 minutes left. What are your parting ideas for what you want to make sure that people know about student loans?
I think the most important thing with the student loans is, first of all, take advantage of PSLF. If you work for a nonprofit, it is definitely the best way to go. You can get your loans forgiven in 10 years, and then the balance isn't taxable, which is great.
The website again is?
Studentaid.gov.
Studentaid.gov. Okay, great. And I'm going to put that on my website too, so that people can, okay.
So I think that's the biggest thing. And then the next thing is to look at income-driven repayment plans, because those are great. Like if you qualify for these, a lot of times you can pay so much less than what you're paying under a standard repayment plan. So it really is good to know your options. And some of these income-driven repayment plans allow you to file your taxes separately, so that they only look at your income. So that significantly reduces the payment. So I think takeaways would be PSLF and income-driven repayment plans are big ones.
Okay, great. So for more information about Patti, you can check out Lake Life. I struggle over your business name, Patti.
Lake Life Wealth Advisory Group.
I love that name, by the way. We went over so much material. I'm going to post it on my blog because it has gotten pretty detailed. So check out sullivanmermel.com and the blog posting about student loans. While you're there, sign up for the newsletter. If you want to be notified about upcoming shows, we send out an email before each show. My name is Bridget Sullivan-Mermel, and I own a fee-only financial planning. If you've got questions on this episode or for future episodes, please email us at ask@chicagomoneyshow.com. Thanks for watching.
Thank you. Thanks for having me.
Thanks, Patti. Thank you, Patti. I really appreciate you being on.
Thanks.